Hello, everybody. Good to see you. Sorry, my chair is falling off the roller pad, and it's a little awkward. So sorry to be in your face this morning. So good morning, everybody. Welcome to Tuesday. Welcome to our webinar. We're going to jump right into it. It's 10:01. So I see people coming in. If you missed the beginning of this, you have an opportunity, of course, to see it on the recordings. You can see it, you can access the recordings on our website. I know many of you have been doing that, so I appreciate that. I've also received some really good feedback about the content, so we're going to continue the content we've been doing. Everybody kind of has some feelings about the market information and the slot information, and of course the financial planning topic. So no reason to change it now. I appreciate everything that everyone has, all the feedback everyone's given me. So just hit the raise hand button if you can hear me and see me okay. Thank you, everybody. So I look forward to seeing all of you who are going to join us next Wednesday at the Newtown Theater for the David McKnight live event. Joe Garvey is going to be giving us supplying some great food. We'll have some wine and beer there, maybe just wine. I'm not sure yet, but some kind of drink. And then there's a VIP event for you folks. As you know, I hope you've all received the emails. If you haven't received an email invitation and you're on this webinar, please email me and I'll make sure you get one. But it is a week from tomorrow. So the 27th, the VIP event goes from 5 to 6:30, or excuse me, 5 to 6 p.m. And then the main event is from 6:30 to when we end, probably about 8:30. So looking forward to that. We've got some classes coming up. Our classes, it's going to be a webinar again. The webinars have been, very successful. I'm just really leery about going back into a classroom. Hopefully, maybe this summer. It seems like every time I want to book a classroom, there's some kind of, new string of something or strain of something. So hopefully that's all behind us. And we can start live classes sometime, maybe in the summer or in the fall. But this one's going to be a webinar. So it's you'll receive an invitation, as you always do. If you want to pass that on to friends, family, other loved ones, you can certainly do that. It's going to be 2 3-hour classes. I know that's long for a webinar, but I've done some, taking some opinions out there, and people seem to like the 2 classes instead of 3. I have one in June. I might try the 3 classes just to give a little bit of diversity in the options. But I know 3 hours is long. Believe me, it's a long time to be speaking into a camera. But it seems to be the most effective for everybody's time. So that is beginning on the 12th of May and the 17th of May. Remember, we go Thursday and Thursday and Tuesday and Tuesday. So we have 2 classes, the 17th and then whatever that following Thursday is, and then the 12th and the following Tuesday. I want to remind you all that your Q&A is available at the bottom of the screen. Chat should be disabled. I actually don't even see it anymore. This webinar, you are muted, and this webinar is recorded. So we're gonna begin, and we're gonna start with our 15 minutes of the slot updates. We're gonna talk about some market updates and analyst reports. And when I say 15 minutes, it's about 15 minutes. Could be a little longer, could be a little shorter. And then we have a financial planning topic. And today's topic is going to be, why is 2030 so important? So this came up for a couple of reasons. First of all, I had a client ask the question last week. So many of my topics that I talk to you about for financial planning come from live conversations, real conversations that I have with clients, and it sparks an interest in me. And then I figure if one person's asking a question, there could be many. So the feedback, and just the conversation I have with you folks is very, very important. And they asked, why, I'm hearing about this 2030, 2032 number. Why is that so important? So we're going to talk about why that's important. And the other interesting thing on this, and this happens ironically quite a bit, or coincidentally quite a bit, is that I was catching up on David McKnight's podcast, and he talked about this question. So I've got just some fresh information from him as well. So that's helpful. So let's talk about some of the headlines out there. So, we talked about inflation last week. The consumer price index came in at 8.5% year over year. Many people are talking about that being the cap, hopefully, but I'm starting to hear rumblings of about 9.2 for next month. And I hope that's not the case. But, mortgage rates, we saw 30-year mortgage rates at 6.875 yesterday. Wow. So that's something we haven't seen in quite some time, so almost 7%. So hopefully they drop back down, but it just goes to show you that the Fed really doesn't drive everything, right? So the Fed funds rate, target rate went from 0.25 to 0.5%, but the mortgage rates dropped or increased. For many folks, that's doubling, right? We were seeing rates at 3% and below. So that's more than doubling. So it's going to be interesting to see what happens with the residential housing market. We still have a lot of uncertainty and shock waves from the Russia-Ukraine war, the Russia invasion of Ukraine. So there are just a few of the headlines. There's a lot of different headlines out there that are really interesting, but this whole play with personally that I'm following with Elon Musk and Twitter and what's happening with that is really, what these billionaires do is just really interesting out there. So, all right, let's jump into the Slott mailbag and the Slott report, as it's called. So the first is from the mailbag. So the mailbag is when somebody writes in. And this is Sarah Brenner, who you all met just last month, March, answers this question. And the question is, the first one's relatively easy, but again, I like to read these reports and these questions because these are things that come up all the time. So if you've been listening to these webinars now for a year or two, you might really know the answer to these questions, but these things pop up and it's always good to review these. And this one has to do with an inherited beneficiary IRA. So the question is, the client 72 has recently inherited a beneficiary IRA. My question is, for the next year, can she use a qualified charitable distribution for a beneficiary IRA? So this is either from a financial planner, a financial advisor, or from a CPA. And we get the Slott group gets these questions all the time from professionals. So the question again, the client is age 72, has recently inherited a beneficiary IRA account. My question is, for the next year, can she use the qualified charitable distributions for her beneficiary IRA? Thank you, Kathy. So Sarah writes back, Kathy, yes, this will work. Beneficiaries can take qualified charitable distributions, or QCDs as they're called, from inherited IRAs as long as they're over 70 and a half. So this is the IRS rules around IRAs, inherited IRAs and distributions just continue to get more complex. They don't get easier. They haven't gotten easier. They're just getting more complex. And this is an example because now the required minimum distributions are age 72, but you can still do the qualified charitable distribution at age 70 and a half. And sure, that's beneficial, but these mismatched dates or ages lead to confusion. So just to remind you, a qualified charitable distribution is an allowance where you can take money directly from your IRA after you reach age 70 and a half, not in the year that you turn 70 and a half, but you must have already passed that 70 and a half birthday or half birthday, and send that money directly to a charity. You can't take it into your bank account and write a check for charity. You have to send it directly to a charity, and you don't pay tax on that, right? So, and it's up to $100,000 per individual. Right now, there's discussion about inflating that. But if you're charitably inclined, it's a really great way to draw down your IRA and not pay any tax on it. But it must go directly to a qualified charity. So the next question has to do with 401ks. So this is just from an individual. So dear Ed Slott experts, I changed my job in January. Oh, I'm sorry. I'm supposed to be sharing this. So let me share my screen here. And I'm sharing my notes just so you can follow along. Okay, so here are now you can see it. So now I have to remember not to share my notes when we're done. And again, it's just my notes. There's no client information in here. But let me just make sure you're seeing the right screen. Can you raise your hand, like push the raise hand button on there, if you can see my notes and the question, dear. Okay, thank you, everyone. So I changed my job in January 2022. I'm right here. And my new employer does not allow me to contribute to a 401k plan this year for a year after employment. Other than an IRA, is there any other way to contribute to a 401k or some other type of retirement plan, pre-tax plan, so it will help with my tax situation? So this person's focused on reducing their income, reducing their tax. So then the answer is, unfortunately, this is a predicament that many workers find themselves. If your employer does not offer a retirement plan, your options are limited. You must be an employer to be eligible to establish a qualified plan. If you have a side job, you may qualify as self-employed. That's pretty easy to do too. In which case you could establish a plan for your business. If you do not, an IRA would be your only option, right? So if you're over 50, you can contribute $7,000. If you're under 50, it's $6,000 this year. So not a lot of money that you can put aside. If neither you nor your spouse participates in a plan at work, your IRA contribution would be deductible. That could help with your tax situation. Of course, this person probably wants to look at doing Roth IRA contributions if they can, but that's the good answer for that question anyway. So if you are self-employed, there are a lot of options. It's really easy to set up a 401k, an individual 401k these days. They're relatively inexpensive and easy to do online. They have decent investment choices, but you can push a lot of money into them. 27,000 this year if you're over 50. And if you and your spouse are employed in this job, then you can do contributions for both of you. There are SEP IRAs you can do that have very generous contribution levels, and simple IRAs that also you can do, which are much more complex. But if you can identify yourself as self-employed, it can be it doesn't just have to be that's your sole job. You can also have a job as well. So Andy Ives, who you've also met, this is a good piece. Last minute IRA tax deadlines and rules. Now, the tax day was yesterday, right? You had to have your payments in, your quarterly estimates in, and unless you filed an extension, your tax return in. So that was yesterday. So a little bit of this is prior. You see, this was written April 13th. So that was the day after our last webinar. But let's go through this. So Andy writes, the deadline for filing your 2021 tax return is this Monday, April 18th, yesterday. It's extended through the weekend because the IRS offices in Washington, D.C. are closed on Friday, April 15th, in observance of the locally recognized Emancipation Day. As such, I actually didn't know that. I thought it was, it was also Good Friday. So I guess, there's quite a few things, but that's interesting. It's good. As such, this buys all of us a couple extra days to complete our returns. Again, too late. They were due yesterday. For procrastinators or those who simply had time get away from them, there is still sand in the hourglass. Complete certain IRA transactions. However, not all options are available. Here are some important IRA deadlines and answers to common IRA tax filing deadline questions. Prior year traditional IRA, Roth IRA contributions. This is a confusing one for some people. There is still, now not anymore, but Andy writes, there's still time to make a traditional and or Roth contribution for 2021. The deadline is April 18th. Today's the 19th. Please don't call me and say that you want to make a contribution, because you can't. The deadline was yesterday. This deadline does not include extensions. So very appropriately in capitals, does not include extensions. I do hear this all the time. Well, don't I have until I file an extension? Don't I have until October? No. So even if you file for an extension, that does not allow prior IRA contributions beyond the 18th. Note that if you do make a timely prior year Roth IRA contribution, and if it is your first foray into the world of Roth IRAs, congratulations. You just shaved 15 months off your IRA 5-year clock and earned a January 1st, 2021 start date. So that's a good point. You want to get that 5-year requirement or Roth IRA requirement started as soon as possible. So even if you're kind of on the fence about doing Roth contributions, Roth conversions, get a little bit of money over there just to get that started. Again, the 5-year rule is very complex under 59 and a half, age 59 and a half. It's very, very simple over age 59 and a half. SEP contributions, self-employed pension. Self-employed pension. I think that's what it is. Self-employed pension. I haven't looked that up in a while. Contributions. Business owners with a SEP IRA can make 2021 contributions up to the business tax filing deadline, including extensions. You see, this is why it gets confusing. Some things are allowed with extensions, some aren't. This runs counter to the IRA deadline mentioned above, and this is a source of some confusion. How about backdoor and regular Roth IRA conversions? While we know the Congress is targeting the backdoor Roth IRA strategy, it's still alive and well as far as of this writing, excuse me. For those taxpayers who cannot contribute directly to a Roth IRA due to the income limits, the backdoor Roth strategy allows them to make a non-deductible traditional IRA contribution and then, minding the pro rata rule, this is a complex maneuver, immediately convert it to a Roth IRA. As mentioned, while a prior year 2021 contribution can be made up to the tax filing deadline, any conversion done in 2022, either a backdoor or regular conversion, will count for 2022. So conversions have to be done by the end of the year, the calendar year, to count for that year. If there is a simple fix I could make in Washington, just a simple one, it would be that we would be able to do Roth conversions up to the tax filing deadline. So in this case, up to April 18th for 2021, because that would make our planning much, much easier. But the IRS doesn't seem to care about that. So they make it more challenging for us. All right, so where were we? So there's no such thing as a prior year conversion. The deadline for the 2021 conversion was December 31st of last year. That's what I just said. So fixing an excess IRA contributions we're talking about. Anyone who erroneously contributed to a traditional Roth IRA in 2021, either by contributing too much or maybe simply changing one's mind, can still correct the situation. And you may have more time than you think. The deadline for correcting an excess, either by removal without the 6% penalty or recharacterization, kind of just undoing it, is the extended tax filing deadline, whether you actually go an extension or not. So you actually don't have to file for an extension, but you still have, in this case, until October 18th, 2022 to correct any erroneous Roth IRA or traditional IRA contributions only for 2021. The next confusing date that we should pay attention to, and we talked about it a bit in the earlier discussion, was QCDs, qualified charitable distributions. A qualified charitable distribution allows IRA owners who are 70 and a half and older to send money directly from an IRA to a qualified charity. The donation is removed from income and is typically used to offset all or a portion of a required minimum distribution. This is where it came about. And that's the 70 and a half just stuck there. They didn't move it up to 72 when they changed the RMD rule. And that's a good thing. Again, it just leads to confusion. As with Roth conversions, there is no such thing as a prior year QCD. While your tax software may inquire about any charitable giving you did, know that any QCDs during 2022 will only count for this calendar year. Good point, Andy. As we race toward the tax finish line, already passed, be sure to understand which IRA transactions can still be done for the next few days, already gone, and recognize those that cannot. So good point, Andy. All right, let me stop my share. All right, I hope you enjoyed the slide updates for today. We're going to talk about the markets. So not great news. You know, we continue to trend down. We made a lot of adjustments to our investment models. We are nearing the time that we're going to make changes. I talked a lot about that last week. I spent a good 15 or 20 minutes. When we are ready to make changes to the models, we will have a webinar for you to discuss the changes of the the models for clients, and that will be recorded and sent out. It will not be on the website because I do not want to share our models with the general public, right? I want to just share them with our clients. So that will not be on the website, but it will be available. If you don't, for some reason, have the link, you know, from email, just let us know and we'll send it to you. But that hasn't happened yet. I am, you know, I'm looking for a date because I don't want it to be too far away from the rebalance and readjustment of the portfolios. What we're working on right now is our portfolio rebalancing and purchase, the tool that we use to trade. That's through Morningstar, and it's a pretty steep learning curve, and a lot of information has to be put in there. So we're working on that. All right, so I don't think I'm sharing. Okay, that's good. I don't want to be sharing. So let's talk about the markets overall. So the Dow Jones Industrial Average was down again last week. So this ends week 15, 2022, 0.78% for the Dow, another 2% for the S&P 500, and over another 2%, 2.62 for the NASDAQ. The NASDAQ is now down 14.5% for the year. It's just, it's such a shame. It's so hard. All the stock indices I'm seeing were down. I'm sorry, the world small cap index was up 0.04%, so just barely, still down 8.5% for the year. Most frustrating for most investors, though, is the bond market. So that Barclays aggregate bond market is down 8.5%. Many bond funds are down 10, 11%. Very challenging because most investors think that you're offsetting the risk of your stock with bonds, and we're seeing the opposite. And in fact, if you just look at the most common investments, the S&P 500 and the Dow Jones Industrial Average, and the most common bond index, which is the Barclay Aggregate Bond Index, the bond index is actually down more than the stocks. So we've done a lot of work to help offset that. I'm still disappointed in the performance of some of our bond funds, and that will change very quickly, as soon as possible. But and again, we went through and talked about the changes we're making last week. If you want an overview, that information is on the website. We just didn't get into the specifics as far as holdings, right? Like what we're doing with individual securities. But it's going to be shocking for many people who, have the target date retirement funds where it automatically shifts into a higher bond allocation, who just think that, use that rule of thumb, or that, the older you are, the more you shift into bonds. And if you're 70 years old, you should be at 70% bonds, 30% stock, and using the most common index, the Barclays Aggregate Bond Index, and knowing that many bond funds, track that, you're looking at potentially being down just about 9-10%. And folks aren't expecting that from their bonds because they haven't seen it for decades. So that's a challenging area. So the U.S. Treasury was up from a week ago, is at 10.7%. The yield on the 10-year Treasury to 2.83. So interest rates are going up pretty quickly, as we talked about. But we're seeing it in certainly we're seeing it in the mortgage market, and that's going to be an interesting dynamic. And we're going to talk about that a little bit more. But that's kind of a snapshot of where we are. Let me tell you some things that are up. Gold was up 1.51%. The US dollar was up 0.7%. Commodity index was up 4.77%. And that has a lot to do with energy and whatnot. And so we're up at 33% so far for that year. So this is, again, a really good discussion about asset allocation and why you don't want to have all your eggs in that, in one proverbial basket. All right, so let's talk about what some of the analysts are saying. One of my favorites as far as analysts is BlackRock's, and they're saying why we still like stocks as yields, right? As bond yields spike. So they're saying in equity, stocks over bonds. We prefer stocks even as bond yields have sprinted higher. Global growth is still solid, and we see central banks ultimately living with inflation. So they're saying that even in this high inflationary environment, that they're still bullish, right? They're actively investing and overweighting in stocks. So that's good to hear. I hope they're right, because we want to keep an allocation to stocks, bonds, cash, and help mitigate it with some of the things we talked about last week. Market backdrop, the U.S. 10-year yields hit new 3-year highs last week. We just talked about that, and stocks continued to fall. The European Central Bank affirmed our view it will normalize policy very slowly. And coming up this week, they were talking about sentiment data this week could show the economic impact of the tragic war in Ukraine, invasion of Ukraine. Chinese gross domestic product data may indicate how lockdowns are affecting growth. There's a lot of lockdowns going on in China, as we know. Still, it's easing here quite a bit. Big decision from the federal courts, whether you agree with it or not, last night, or I guess yesterday, it had to do with some of the masking mitigation on federal transportation. Again, people are either groaning about it or celebrating, but it's moving, it's changing, things are changing. Okay, so now we haven't talked about MFS for a while. So MFS gives me these by the number reports, and honestly, they've been few and far between lately. And I reached out to them and I said, what's going on? I really appreciate these. It gives me some good perspective and it's something interesting to share. So hopefully they're back on it. I think just like everybody else, they've had some labor issues. So this first section talks about the consumer price index. So this is just kind of interesting. For the 9 years from 1973 to 1981, inflation using consumer price index averaged 9.2% a year. But for the 9 years from 2012 to 2020, inflation averaged just 1.6 per year. What's interesting about this, because I always caution against pulling these periods of time out of the air. But what's interesting about this is that, what we're used to is the 1.6. Our financial plans were using 2.43, I think it was, for many, many years. And we just adjusted that up to 3.5%. And that's caused some problems with some financial plans. But, just that small increase. But for 9 years, it averaged 9.2%. So it really begs the question, do we need to change the way we think about inflation? And should our expectation be more like 9.2%? I certainly hope not, but there aren't many tools that can be effectively used potentially to overcome this. So big change is the next one. Inflation using consumer price index. We talked about this, was up 8.5% for 1 year ending the end of March. That's more inflation than the United States experienced over 4 years. So that 1 year increase is more than what we experienced over 4 years from 2017 to 2020. Over that time, the consumer price index only increased 7.9% over the entire 4 years. So there was some polling done last week by CBS News, and they said 63% of 2,000 American adults surveyed during the first week of April this year rate the condition of the U.S. economy to be fairly bad. 32% at very bad, and 31% very, 32% fairly bad, 31% very bad. The dominant reason on these individuals that these individuals were disappointed in the U.S. economy, inflation, and the rising cost of goods and services, which is really the same thing. So people aren't happy about it. And again, what do we have to offset it, to mitigate it, to help it? 60% of American workers born in 1943 were employed by companies that this is the defined benefit plan, right? Like a pension plan. So 60% of American workers born in 1943 were employed by companies that provided a defined benefit pension plan. Now, just 6% of American workers born in 1964 were employed by companies that provided a defined benefit plan. And I'm willing to bet it's smaller than that. The later you go, if you go in the 80s, 90s, 2000s. So from 1943, 60% of Americans had a pension. Those born in 43. Those born in 64, only 6% of American workers. You're going to see it being nothing but government, and government's trying to trim that as well. Let's talk a little bit about the housing shortage. The United States is an estimated 3.8 million homes short of the demand that exists in the country for single-family homes. So this is going to be interesting, right? Mortgage rates they've already increased. It depends on where they stay. I remember my first mortgage. Many of you have, much different stories. I've heard 14, 15% mortgage rates. My first one was 8.5%. And I remember my mortgage broker telling me how great that rate was. So we could see that again. Of course we could see that again. And we're probably likely to see that again. So we have this housing shortage, and then we're going to have the rising costs. I saw something today that showed the median housing price, I guess, in maybe the East Coast. I don't know. Maybe it's in the U.S. $400,000. It sounds high for the U.S., but it could be. And the average mortgage cost, because of the new interest rates, is now up $250 a month. That could be the difference between someone being able to afford a home or not. Now, of course, that could drive, and is likely to drive, prices down. And that's fine for those of us who have been in our house in more than a decade or so. But for those of us that have just paid them, a lot of places around here are going for, very close to $1 million. It could likely drive that down back to where it was a short time ago. So the supply of bonds is also set to rise. So after 2 years of adding $120 billion a month of bond purchases, that's an overwhelming number. Also known as quantitative easing, the Fed will begin quantitative tightening in May by allowing $95 billion a month of bonds to roll off its $8.5 trillion balance sheet. So the Fed owns a lot of our bonds now, like way too much, and more than certainly than they ever have. The Fed will not reinvest $95 billion a month of maturing bonds back into newly issued bonds, $60 billion of treasuries, and $35 billion in mortgage-backed securities. And the source for that is the Federal Reserve. So they want to trim that down and get all that off, or a lot of it off the balance sheet. I didn't know this actually until I read the update here, but Russia has until Wednesday, May 4th, 2022, to pay $2.2 billion of foreign debt that was originally due to be paid to an American bank on April 4th. So they're late. They're late in their payment pretty considerably. I would feel really uncomfortable if I was that late in a payment. If Russia is unable to repay the debt in US dollars, must be paid in US dollars, as it's required to do so, the default on foreign debt would be Russia's first since 1917, or 105 years ago. So that's from the Associated Press. So that's interesting. It's going to be interesting to see what happens with that. I'm willing to bet they don't have a lot of extra cash sitting around right now. As of Thursday, 4/14, 57% of the 4.7 million Ukrainians, that's 2.7 million people that have fled their country since February 24th, 2022, have escaped to Poland, a nation of 38 million people. I just thought that was really important to mention. It's a depressing situation that's going on over there, and forget about the economic impact for a second, because it's potentially great, and we haven't really experienced what the majority of it, I don't think, but the human impact is most troubling. Prudential, I pulled one Empower. I pulled one snippet out of Mr. DiLucia's report this week, and the probability, he writes, that the Federal Reserve will engineer a soft economic landing is less than 50%. It's more likely that persistently high inflation will force the Fed to raise its policy rate to prohibitively high levels, ultimately triggering a recession. So of course, it's very challenging for the Fed. We are racing with higher interest rates, of course, and inflation, and it's really hard to just easily bring that back down. So we're going to see a significant shockwave. So we've got to do things today, or very, very soon, to start protecting against that. So it's not all bad, folks. Listen, it's just we've got to stay optimistic. You've heard me say this a million times. You have to be defensively optimistic. So you do this by making sure, you've heard me say this a million times too, asset allocation, principal protection, and account segmentation. Lay in, guaranteed income sometime in the future, but some of these mitigation techniques that we're putting in, the buffering of the structured notes. I don't want to get too much into the details of it. The absolute return strategy we talked about, where we've got high dividend paying issues to help with the overall portfolio and your overall investments. So, but we got to stay optimistic. But we have to be defensive, and we have to pay attention to these things. Got to be prepared for the good and the bad. All right, now let's talk about why 2030 is so important. So we're going to jump to our financial planning topic. I'm going to share my whiteboard here. And I do have a question. Gerard, good morning, Gerard. Many annuity companies have used bonds as a required proportion of holdings. Your thoughts? Well, any bonds are at risk, right? So we're seeing the value of bonds go down. Now, if they own the individual bonds, of course, the bonds are going to, which most annuity companies do, they're not going to buy bond funds. I can't think of any annuity company that would buy bond funds, unless you're talking about some variable annuities require a certain amount of your allocation into bonds. So I don't know, Gerard, if you're talking about a requirement for the individual allocation, investment allocation, or the investments of the annuity company themselves. They're two very different things. So if you're talking about the individual allocations, and they could be that 20%, I'm just kind of thinking what some of the requirements used to be, that 20% of the allocation in a variable annuity has to be in bonds, and it can't be any lower than that. Then you've got to look for probably right now the shortest duration bond fund that you can find to help with the loss, the potential loss, but you're kind of locked into that. Now, if you're talking about the securities, their own investments that an annuity company will handle themselves, they're going to own the individual bonds and be writing options on those underlying securities. So Gerard just clarified variable. Yeah, so this is where individuals have to pay attention to what they own and see if there's any opportunities for changes. You might be able to swap a variable annuity for a fixed indexed annuity, something that's not going to give you any exposure to the downside. But you got to do those things quickly, because my guess is that you could, in a variable annuity, you could easily be down 10% so far this year, and that's when those fees really catch up with you. So be careful. Good question, Gerard. Let me just clear these. All right, let me jump into the financial planning section, and I'm going to share my whiteboard, and I'll move this along as quickly as possible because it's 10:37. I've been able to stop at about 10:45, but this one might be a little bit longer. So just hit the raise hand button if you can see my whiteboard. Thank you. All right, you're going to see me looking down because I draw on this. So the first thing I want to talk about, so why is where are my pens? Why is 2030 so important? Well, the first thing that we've got to talk about is, and we're talking about, when I'm talking about why it's so important, is the majority of our strategy revolves around helping people become tax efficient or tax free in retirement. And we have some hurdles and we have some targets over that time. And 2030 is really where, maybe 2032 is where we want most people to be finished as much as we can, because we really think that this is the point of no return for the federal government. So I was talking to somebody last week and we were discussing this topic, and he said, I have to think that there are people in Washington who are that understand this and are working on it. Well, I'm sure there are people in Washington who understand this and are working on it. I'm just not sure if the people who make the decisions, and I'm talking about Congress, the newest newest person in Congress, and all the way up to the Oval Office. I'm just not sure if they have the wherewithal or the guts to make a change, because the changes are going to be dramatic. So Keith, I saw you raise your hand. If you have a question, put it in the Q&A, please. So we'd like to see 2030 or 2032, these transactions to be done. If you're using life insurance, fund it. If you're doing your Roth conversions, get them done by then. Because the first hurdle we have is the expiration of the Tax Cuts and Jobs Act. So what that means, at the end of 2035, we have this sunset provision. And that's just the way that they were able to get this Tax Cuts and Jobs Act passed. And they said, okay, well, we want to reduce taxes, change the tax structure, which will reduce taxes. That was the idea. But they couldn't get enough votes unless they said, okay, well, we're not going to keep it forever. We're going to let it sunset. So it ends at the end of 2035. So in 12/31/2025, it reverts back to 2017 levels. So I thought it'd be interesting to share with you what that looks like. So let me find that. Sorry to be moving these around. So let's see how much we can put these side by side without it being too small. So on the left here is the 2022 tax code, right? That marginal tax rate. So you can see them. They start at 10%, go to 37%. And over here is the 2017 tax planning. So now you'll see I've got a note here, because this is actually my chart that I keep in my drawer. I went on to, these are from Ed Slott, these charts. I went on to Ed's website, and it doesn't go back to 2017, and I couldn't quickly find it in my records. So I just scanned it in. So I'm sorry, Keith, 2026. So Walter said, is this a recent change? I thought it was 2026. So the the Tax Cuts and Jobs Act ends, right? 12/31/2025. So the new, or reverting back to the old tax law, most of the old tax law happens in 2026. Okay, so I hope that answers that question. Sorry, I just got distracted. So you'll see that the this starts a little differently here. I like the way it used to go. It used to go from the smallest to the largest, and now they go from the largest to the smallest. So it's a little hard to compare, but you'll see that on the surface, 2017 to 2022 doesn't seem to be that big of a difference, right? Well, we started 10, we go to 15, 25, 28, that's different. 25 is different too. 33, 35, and 39.6. And people will say, well, it only goes from 37 to 39.6 for the top people earning over, $650,000 a year, and here over $470,000 a year so adjusted for inflation, that'll probably be like 500 and change if you're married. And I hope you can see this. I know it's rather small, but I'm trying to show it side by side. But that may be true, but let's just erase these and let me draw your attention to the real danger here. And the real danger exists right here. Because right now we love this area, right? 22% and 24%. Because if you, if you just move a bit into the 24%, the top of that 24% bracket, look how much that gives us. We go from $83,000 a year all the way up to $340,000 before you cross into the 32. That helps us move a lot of money for our clients into Roth IRAs. Now, shift back into 2017, and this is where it gets more challenging. But I'll tell you, we can manage it. I started doing Roth conversions on a regular basis for my clients in 2012 after I met Ed Slott, and really he turned everything around for me. So that was well before the changes that the Tax Cuts and Jobs Act. But look at what we're facing here. The 25% bracket, right, starts at 75,000, so not dissimilar to the bottom of the 22. And you might think, all right, 3% more in taxes isn't bad. But the 20, then we top out at the 28, and we top out here at 233,000, likely to be about. That's my note. That's from some time ago, so it probably would have been a couple years old. But about $262,000. So we're losing quite a bit of money that we can shift over to the Roth IRA, and we're paying a higher tax rate for it, 28% from 24%. So it should come as no surprise that the folks that are getting hit the hardest with this change are right in the middle, right? That's what we've been saying all along, and that's what the tax code looks like. Now, again, we can manage that. So that's the first hurdle, is the change to the Tax Cuts and Jobs Act. But we can manage that. I'm confident, and that's built into our plan. We assume the changes to the Tax Cuts and Jobs Act, and most people we can get out, well before this 2032. So why is 2030, 2032 so important? It's because of these factors here: Social Security, Medicare, the national debt, and retiring baby boomers. So, there's a lot of folks. I'm just going to pause my share for a second because I need to pull my notes on another screen. There's a lot of folks, believe it or not, that'll argue the effect on the marginal tax bracket for Social Security and Medicare. I don't agree with that, but let's give them the benefit of the doubt. And here's the concern. So you've probably seen this before by me. And if you think of it this way, we have a couple things going on here. And David Walker first presented a chart similar to this and to Congress. So it's not my artwork. But we have revenue in the form of tax payments, no matter how you slice it, payroll tax or income tax. And then you have expenses. And there's a really strong reason why this is projected to go down over time, and these expenses are projected to go up over time. And that is because of almost probably everybody on this call we have a whole bunch of baby boomers to the tune of $10,000 per day retiring. Well, retiring triggers a few things. The first is less payroll tax, right? The second is Medicare. Because you could argue Social Security, while some people wait until they're age 70, a lot of people don't, but some do. And then the second, but everybody collects Medicare. The vast majority of people start with their Medicare benefits right at age 65. And then the second thing is Social Security. And let's just talk about those two things for a second. Those expenses are going to skyrocket. They're going to skyrocket while we have the baby boomers using the benefits that you've been promised and paid into. And this isn't a negative about the baby. You should have them, right? But the expenses are going to increase, of course, as more people draw on them. And you've got the revenues continue to dip because the generation behind you isn't large enough to support it. And we know that the one behind them, Generation Y, is larger, but still not large enough. And there's a few key points here. And I don't mean to crowd this with many lines. I'm just trying to make my points. So we know there's a trustees report that's published every single year. And the last one in 2021, it was done towards the end of the year. Had a couple key dates, and we talked about this before. Now let's talk about the first one. The first key date is 2026. In 2026, Medicare, which again, you've heard this, is 5 times larger than Social Security. The trust fund that helps fund Medicare not 0%. Sorry, I'm so used to writing that from the tax. It goes to $0. There's no more money left in the trust fund in just 2026. Folks, it's 2022. You can argue it's almost, we're nearing the halfway mark of 2022. So we don't have a lot of time. We have less than 4 years. And I'm willing to bet that this number gets closer. Because when I started drawing this same chart, I think the first number we had was 2030. I think it was 2030. And we've lost years every year that since I've been reading these trustees reports. So that's Medicare. And this trend is likely to go here. So we may see this in 2024. The second is, of course, Social Security. So Social Security, the trust fund is depleted. Let's move it down. Let me undo that. This new whiteboard. Okay. I lost my 4. Let's put that in the crosshairs here. That's 2030. Social Security equals $0 in the trust fund. Now, that doesn't mean that there are no benefits, but there's only a 76%. Let's just see. It's right here in front of me. 76% of Social Security benefits will be able to be paid after 2030 when the trust fund runs to 0. And I actually don't have the number for Medicare, but it is higher than that. Oh, yes, I do. 91%, only 91% of Medicare benefits can be paid. And that reduces to 78% by 2045. And 76%, as I said, of Social Security benefits can be paid. And that reduces to 72% in 2095. Now that might sound like a long ways away, but 76% and 91% is completely unacceptable. Nobody in this country is going to accept that. You've paid into it. Raise a hand. Show me your hand. Hit the raise hand button. If you would accept a reduction of benefits from your Medicare or Social Security by 9% or 24%. Okay, nobody's raising their hand. And that's what I expect, right? And you're representative of the entire country. So why is 2030 so important is because then something has to be done. We're now in crisis mode, right? We haven't even talked about the national debt. So congratulations, everybody. We're at $30 trillion. So let me pull this down so you can see. So this is the U.S. national debt clock. You can pull this up, go to debtclock.org, and you can see our debt. So I hope you're seeing that in the screen share. Please raise your hand if you see that. Thank you. So that's our national debt, and that continues to increase as well. So there's going to be a period of time, and the real question is when. Let me just get this out of the way here. I'm sorry, I don't know how to. For some reason, there we go. I just moved it. There's going to be a period of time where no more can kicking can be done, right? So we believe this is going to be somewhere around 2030 or maybe 2032. No more can kicking can be done. We're in crisis mode. Something has to happen. We've seen Washington move quickly with things like COVID, right? When the COVID crisis came, money got pushed out, and that made things worse, right? It needed to be done. It's very, very important, but that made things worse. So layer over, just with Medicare and Social Security, we've got this problem here, right? Where the can can't be kicked anymore. Something has to be done because no one is accepting a reduction of their Social Security or Medicare. And this is where people might argue, well, they'll increase the payroll tax, so the workers will have to pay more, but not us in retirement. But you can only push so much, and to close this gap, the math tells us that you'd have to take really almost all, if not a significant portion, depending on what the income level is, of a worker's income. But again, that's just for Social Security and Medicare. Layer over the national debt, will very soon, let's keep this in red, be paying $1 trillion per year just in debt service. So again, this is where, and the only place to go to fund that is the tax coffers, right? More revenue into the federal coffers, because as this continues, the revenue has to increase somewhere. So at what point do they say, okay, here we are, now we've got to move this trend line up on the revenue side to match expenses, because the expenses are just going to increase, right? They have to. You're going to see a significant increase in Social Security this year. That's just going to compound this problem. Nobody saw these big inflation numbers coming, but Social Security is going to have to increase. We already see a high inflation with Medicare. So that is why the 2030, 2032 time period is so important. There is no doubt that if you can, we want to get past this Tax Cuts and Jobs Act, because it's just beneficial, right? You can move more money for less tax between now and 2025. Don't miss a single year, but it's manageable. If this is what we end up with a tax code, and back here in 2017, it's manageable. But 2030, 2032 is a very important time, and I would focus more on 2030. I will mention, and David mentions this in his webinar, that if there is a significant shift, and this is not a political statement, if there's a significant change in the White House and Congress and the Senate, I'm going to stop sharing here, at like a red wave in the next election, it's likely that the Tax Cuts and Jobs Act gets extended. That's great for us from a planning point of view. That'll allow us, our clients and the folks who follow our principles, to move more money to tax-free. That's good for you. Really, probably terrible for the future economics of the country. So when someone says, I hope somebody in Washington is paying attention. Like I said, there are people in Washington paying attention, but the people who can really say yes or no, draft the bills, do the proper votes, I don't have faith that they're going to do it until it becomes a crisis situation. I would love to see a bunch of engineers and forward-thinking people head to Washington, but that's not what we're seeing. So listen, again, I don't want to be pessimistic. My passion, and I'm working on a way to get it out to more people, because we can only take so many, right? We have new people right now that are already waitlisted really until next month. So when a new client comes in, we can't just onboard them tomorrow. We have to wait. We do about 2 clients a month. Sometimes we can wiggle in an extra one depending on how the staff feels and what's going on. And we're just coming out of the flurry that's been the last few months with this transition. I hope it hasn't felt that way to you, but it's been extremely busy for us. But the passion is to get, we can't save all of America, right? We can only do that by changing legislation. I'm not a legislator, and I'm not going to be, but we you know, we want to be able to help as many people as we can. That's why when I have an opportunity to coach other financial advisors and financial planners about tax-free structures, bring on more CPAs, I always take that opportunity. But share these things with your friends and loved ones, because we've got to get the word out there, and we want to protect the people that we want. I know you folks will be out of the way of it, right? We're going to work hard, do what we have to do to get you out of the way of that, the train we talk about, but it's coming, and it's unavoidable, unfortunately. But that's why 2030 is so important. But we have to be optimistic about it, because there is still time. For most people, we still have time to get it done. And your age doesn't matter. It's not about your age. It's about the time that we have to do it. But if you procrastinate, you're not sure, and you want to just do a little bit and see how it goes, it's troubling, and it just makes things more challenging. So we have a couple questions. Let's see. Okay. So Walter, I don't know if I said 2035, I misspoke. I apologize. 2035 was the number. So I think I erased the previous question, but you're talking about Tax Cuts and Jobs. 2035 doesn't exist, really. It's 2034 for the Social Security, 2026 for Medicare. So I apologize. If I said 2035, that's not what I meant. I meant 2025. So Richard asked, do you expect the standard deduction to be reduced back to 2017 levels? I expect the standard deduction and the personal exemption to return. Before Tax Cuts and Jobs Act, it was two things: standard deduction and personal exemption. I expect that to return. I expect it to be indexed or adjusted for inflation up to about where we are today, because the total didn't change much. It just made it easier. It was a standard deduction. So really great questions. I hope that was helpful. I hope it was clear. I hope to see you all next Wednesday, and of course next Tuesday, and it is 10:58. It's time to sign off. Have a great week. If you have any individual questions, send me an email. If you want to make an appointment, a calendar should pop up. If you're an existing client, you already have an appointment scheduled, please keep your existing appointment. But if you're an existing client and you need something immediately, just reach out to us. We are here for you. You don't need to wait to schedule an appointment. Just reach out to us, either call us, send an email. And I hope you all have a great week. I hope you get outside, have some fun, and we'll talk soon. Take care.